A staggering $1 trillion worth of shares vanished in less than 30 minutes, plunging the world's largest markets into panic and 15 minutes of sheer chaos that shook the financial world to its core.
Fear came back into the market in a very big way. What began as a national problem in Greece has quickly metastasized.
Down 400 very quickly, and then down 800, nearly 1,000 in a heartbeat.
I mean, it is classic capitulation.
There are some people who are proposing there was some kind of fat finger error.
We have commodities that are being crushed.
There may have been a bad print in Procter & Gamble.
This is very much 1987.
Biggest single widening day since we...
There was panic selling on the way down, and all of a sudden it just stopped on a...
While numerous factors contribute to the fluctuation of stock prices, the idea that a single individual could manipulate the market may seem far-fetched. However, this notion has turned into reality in 2010 when the stock market experienced manipulation by a lone individual, leading to a $1 trillion loss. Operating from his parents' home in Hounslow, West London, this self-taught trader earned the nickname Hound of Hounslow, reminiscent of the notorious Wolf of Wall Street fraudster. On May 6, 2010, the world witnessed a day that would go down in financial history. What started as an unassuming day swiftly turned into a saga of chaos and upheaval in the U.S. stock market. At 2:32 p.m., a ripple emerged, unnoticed at first, but soon growing into a tidal wave of uncertainty and panic. Stocks began to plummet at an alarming rate, catching everyone off guard, and investors watched in disbelief as the market descended into turmoil, with each passing minute exacerbating the situation. The once stable stocks saw their values evaporate at an unprecedented speed, leaving traders and analysts alike stunned and bewildered. This event, now famously known as the 2010 flash crash, lasted a mere 15 minutes, but left a lasting impact, with losses totaling a jaw-dropping $1 trillion. Amidst the chaos, amidst the panic, there was one figure who remained calm, perhaps even triumphant: Navinder Singh. From his home in London, he managed to cause 15 minutes of pure turmoil and monumental disruption, a feat even he found unbelievable. Sarao started his trading journey with humble beginnings. In 1982, Sarao's parents made a significant decision to purchase a house in Hounslow shortly after immigrating from Punjab, India. The housing prices here were relatively affordable. However, this choice meant Sarao's parents had to work tirelessly at multiple jobs to make ends meet. Their primary motivation was to provide their son with the opportunity for a better future, and they believed that a good education would be the key. Fast forward to 2001, Sarao embarked on his college journey, pursuing a degree in computer science and mathematics. To alleviate the financial strain, Sarao opted to share accommodation with a few roommates. Among them was a roommate who always seemed to have extra cash on hand. Intrigued by his roommate's financial situation, Sarao decided to inquire about his secret. His roommate revealed that he had invested his student loan in tech stocks through a brokerage account, and this revelation sparked a sense of curiosity and excitement in Sarao. He realized that this alternative approach to managing finances had the potential to yield higher returns compared to his part-time job at the local supermarket. This newfound perspective ignited Sarao's interest in exploring the world of investment and finance further, but little did he know that this conversation would mark the beginning of his own journey into the realm of financial literacy and investment strategies. Driven by his obsessive nature, Sarao delved into the world of trading with fervor. Spending hours online, he absorbed every piece of information he could find. This trait wasn't new to him. In high school, Sarao's obsession with FIFA saw him spend countless hours honing his skills, eventually ranking among the top 200 players globally. Transferring this focused mindset to trading, Sarao opened his account and initiated small personal trades. However, he soon faced losses, yet he viewed these setbacks as valuable lessons, recognizing that the price of experience sometimes necessitates initial failures. Sarao remained undeterred, knowing that each mistake brought him one step closer to mastering the art of trading. 2 years after graduating from university, Sarao found himself still living in his childhood bedroom at his parents' house, juggling odd jobs to help support the family. From telesales at Dial-a-Phone to an admin role at Bank of America, Sarao worked tirelessly, all with the aim of easing the financial burden on his parents. One evening, while flipping through the local newspaper, an ad beckoned him, "Futures traders wanted, must work well under pressure." Seeing an opportunity to make a significant financial impact and support his family, Sarao set his sights on the job. His ultimate goal? to out-earn even the legendary Warren Buffett. The trading firm he applied to, IDT, didn't make entry easy. Sarao faced a rigorous application process, including a 3-part test, a quick and mental agility test, a pattern and recognition test, and finally, a challenging interview on hypothetical trades. In May 2003, Sarao joined a select few survivors in the office for the first time. Most of his colleagues were in their early 20s, like him. Together, they embarked on months of simulations, theoretical explanations, and lessons in trading psychology, all in pursuit of mastering the art of trading and securing financial success. After weeks of intense training, the rookie traders bonded closely, feeling like brothers. Finally prepared to take on the markets, Sarao spent 8 solitary hours at his desk, focused solely on trading. He preferred solitude, avoiding distractions from the office's noisy environment and negative chatter broadcasted through loudspeakers. Known for his absent-mindedness, Sarao sometimes forgot to remove his bike helmet, indicating his relentless pursuit of profitability. Trading in the S&P 500 E-mini futures, he arrived at the office in the afternoon to trade the U.S. markets until late evening. During breaks between trades, he squeezed in pull-ups or managed his football team on his phone. Sarao's trading strategy was scalping, rapidly entering and exiting positions multiple times a day. Unlike his peers, he avoided using stop losses, preferring to let his trades breathe, a riskier approach that required unwavering focus for extended periods. Rather than relying on traditional chart analysis, Sarao obsessively focused on the latter. In video games like FIFA, Sarao excelled by analyzing opponents' playing habits until he found an opportunity to exploit. Similarly, in trading, he applied the same principle. His focus shifted to observing the movements on the trading ladder, despite the anonymity of digital trading. Despite the impersonal nature of digital trading, Sarao noticed patterns in trading behaviors. By specializing in trading the S&P 500 E-mini futures, he began to discern the movements of market makers. He observed that 9 out of 10 orders remained unfilled, indicating the prevalence of bluffing strategies. In this digital arena, Sarao found himself competing against some of the most skilled traders worldwide. In 2005, the trading firm IDT made a move to Woking and rebranded itself as Futex, signaling growth and expansion. As the firm flourished, more recruits were brought on board. However, not everyone within the company shared the same level of satisfaction. At the helm of Futex was Paolo Rossi, the firm's founder, alongside his brother Marco Rossi and Dan Goldberg. Paolo, with his background in futures trading from the London pits in the 1980s, lived a lavish lifestyle, residing in a mansion and driving a Ferrari to the office to inspire the newcomers. While some found Paolo's charisma and tales of past successes captivating, Sarao remained unswayed. He was determined to carve his own path to becoming the greatest day trader in the world, and didn't believe Paolo's experiences would contribute to his success. Sarao wasn't intimidated by his bosses. Instead, he felt they were holding him back from reaching his full potential. Marco Rossi, responsible for day-to-day operations at Futex, assessed traders' performances and adjusted their capital and risk limits accordingly. Whenever Sarao achieved significant returns, he boldly approached Marco, demanding higher capital and risk limits. Their interactions often escalated into heated debates, with both parties exchanging harsh words in front of the entire trading floor. Despite the apparent toxicity of their relationship, Sarao's unwavering confidence and impressive trading results gave him leverage in these confrontations. While some may see this dynamic as stifling Sarao's pride, his confidence as a trader allowed him to continually refine his skills. The imposed risk limits served to temper his aggressive approach. To push Marco into granting him more trading capital, Sarao faced constant challenges to improve his skills. However, alongside his trading growth, Sarao's frustration also mounted. Unable to contain his emotions, he vented his pride and frustrations on online trading forums under the alias That's Fugazi, accompanied by a Joker avatar. Sarao often shared his disdain for common trading theories, such as Ralph Wilson Elliott's Elliott Waves principle and William Gann's principles based on astrology and geometry. He found such techniques unconvincing and overly limiting, preferring to view the world through a more complex lens akin to a matrix. After 4 years of refining his scalping strategy on the S&P 500 E-mini futures, Sarao had amassed a substantial account size of £400. His reputation as a skilled trader was solidified, with many traders unable to last even a day in the markets. One fateful day in early 2008, Sarao's attention was drawn to unusual movements on the trading ladder. With whispers of an impending financial crisis circulating, Sarao remained glued to his desk as the S&P 500 experienced unprecedented volatility, moving 5% in a single day. As the turmoil unfolded, Sarao also noticed irregularities in the DAX, Germany's top 30 companies index, which he had recently begun experimenting with. Despite the market's negativity, Sarao observed a peculiar phenomenon on the DAX ladder, a stack of buy orders continually replenishing, signaling an anomaly he had never encountered before. Recognizing his limited expertise in the DAX, Sarao turned to his comrade Young, a fellow Futex trader known for his charisma and expertise in trading the DAX. Young, equally surprised by the market's behavior, noticed that while most markets plummeted in the evening, the DAX consistently climbed. However, the trend abruptly reversed the following morning, indicating a sudden halt in the buying activity. Sensing an opportunity, Sarao and Young devised a strategy to short the DAX overnight, capitalizing on the downward trend. Their gamble paid off handsomely, yielding significant profits over 2 weeks as they repeated the trade, hoping their winning streak would endure. Buoyed by his successes, Young continued trading the DAX throughout the day, often giving back a significant portion of his profits. In contrast, Sarao remained steadfast, allowing his winning strategy to flourish. By mid-January, Sarao's account balance skyrocketed to £1 million. However, on January 19, 2008, news broke about Jérôme Kerviel, a 31-year-old French trader who had been illegally using his bank's funds to buy long positions on the DAX, resulting in a staggering loss of $7.2 billion. The revelation sent shockwaves through the financial world, causing the DAX to plummet further. While Sarao's account soared to new heights, the financial system he operated in evolved. Around 2007, the market dynamics began to shift. Sarao noticed peculiar movements in the trading ladder at Futex, coinciding with a period of increased volatility and losses among his colleagues. This trend persisted in the months that followed, signaling a changing landscape. Despite Sarao's growing influence, he found himself struggling to interpret the ladder movements. Spoof orders and faster fills became commonplace as the market evolved. Sarao realized that his adversaries were no longer just human traders, but sophisticated algorithms. Firms like GetGo and Jump Trading, early pioneers in quantitative trading, were employing coders to automate trading strategies. By 2008, these algorithmic traders, or quants, accounted for 1 in 5 trades, reshaping the market dynamics. Exchanges began offering lucrative commission cuts to attract these high-frequency trading algorithms, further amplifying their dominance. Sarao recognized that the same exchanges responsible for facilitating trades were also tasked with policing traders, highlighting the increasingly complex and automated nature of the financial markets. The founders of the CME Group, such as board member William Shepard, also held significant shares in quant firms like Jump Trading. This interconnectedness blurred the lines between traditional trading institutions and high-frequency trading firms like Citadel and Jump. With their faster trading speeds and reduced commissions, the rise of algorithmic trading marginalized many human scalpers, including Sarao. He harbored a deep disdain for the quants. To him, they weren't just robots, they represented the wealthy elite. How could he, an individual trader, compete against faceless billionaires? The once level playing field of the markets now seemed tilted beyond his reach. Sarao, like many other traders, attributed much of his losses to the dominance of algorithmic trading. Unbeknownst to him at the time, some of the trades he bemoaned as the work of algorithms were actually executed by human scalpers. As Sarao's frustrations with trading grew, so did his resentment towards authority figures and the increasingly impenetrable nature of the market. Sarao's frustration with the market's inequities reached a breaking point, leading him to go on strike at Futex. He felt the 90-10% split he received wasn't fair. He clashed with Marco, disrespecting his bosses openly and irreparably damaging their relationship. Things took a turn for the worse when Sarao received a notice from the tax authorities, fueling his paranoia and blaming his bosses. Determined to leave Futex, Sarao sought to cash out his $3 million account. However, the Rossi brothers resisted, insisting on resolving matters with the tax authorities first. With the intervention of a prominent lawyer, Sarao finally prevailed, forcing his bosses to release his funds. With his mentor gone and the shackles of trading risk limitations removed, Sarao, now unrestrained, was more determined than ever. However, the aftermath of the confrontation left him even more frustrated and paranoid, feeling as if the government was targeting him. In this vulnerable state, Sarao encountered Mr. Jesus, who presented an enticing opportunity to manage his money. Promising significant growth and the elimination of tax burdens, Mr. Jesus's offer appealed to Serrao's ambitions. Agreeing to the partnership, Serrao ventured into managing funds. On November 20th, 2008, amidst the peak of the financial crisis, Serrao relocated to a trading firm near the Tower of London, partnering with a new broker, GNI. With reports of the U.S. government intervention, Serrao seized the opportunity, initiating futures buying on Friday morning. As the markets rallied in the following weeks, fueled by the Treasury's announcement of injecting trillions into Citigroup, Serrao doubled down on his investments, anticipating further gains. As the financial recovery seemed to plateau, Serrao's new broker grew anxious, especially as Serrao approached his margin limit without setting a stop loss before the U.S. market closed. In a panic, the broker called Serrao, only to be met by his mother, who woke him up. After hanging up, Serrao watched as the market surged later that day when the Fed announced a $600 billion injection to ease liquidity flow. Despite the opportunity to cash out, Serrao held his position. As he enjoyed a meal at McDonald's, the market rally continued, resulting in a staggering $15 million profit from a single trade. Emboldened by his success, Serrao plotted his next move, a rebellion against the Matrix. On Friday, June 12, 2009, Serrao took a strategic step by contacting his broker to connect him with a trading technology expert. In his follow-up email titled Matrix, he outlined his precise requirements. Facing formidable opponents with superior capital and technology, Serrao realized he couldn't outpace algorithms with his own software. Instead, he devised a plan to disrupt their signals, aiming to manipulate supply and demand to his advantage. By distorting the algorithm's functionality, he aimed to seize control of the market, enabling him to buy low and sell high. While placing fake orders at the back of the queue showed some effectiveness, Serrao realized he needed to make a more significant impact by getting closer to the best offer. However, there was a risk of losing millions if his orders were filled. To mitigate this risk, Serrao devised a strategy to dynamically adjust his orders each time someone else modified theirs, ensuring he stayed at the back of the book with +1-1 deviations while maintaining his position size. To implement this strategy, Serrao partnered with an engineer based in New York named Antonio Hedrugializ. Antonio flew to London for meetings, and after some collaboration, successfully enabled the cancel if close option. However, developing the back-of-the-book functionality proved to be more challenging. Most high-frequency trading firms prioritized speed, while Serrao's strategy required the opposite approach. Antonio promised to investigate further. As months passed without hearing from the engineer, Serrao followed up in November, expressing that the tool he had developed was proving to be highly effective. Despite his newfound success, Serrao remained secluded, conducting his nocturnal trading operations from a small bedroom in his parents' house. It was a surreal experience, building a money-making machine in secret. Just the previous day, he had pocketed $435,000, surpassing the value of his parents' home. From the early days of his career, Serrao had chosen not to disclose his financial achievements to friends or family, fearing their changed perceptions. However, his secretive approach drew attention when an in-house member of the CME flagged suspicious activity. Serrao's orders were mysteriously vanishing. In response, Serrao casually brushed off the warning, attributing it to a demonstration for a friend and questioning the crackdown on high-frequency trading firms. Undeterred, he continued using his program the next day. On Election Day, amid Britain's post-financial crisis turmoil, residents made their way to the polling stations. The crisis had caused a surge in uncertainty, fueling volatility in the markets, which presented opportunities for traders. Between mid-2009 and April 2010, the global stock market rebounded from its lows, but concerns over the debt-ridden EU countries, particularly Greece, persisted. As protests erupted in Greece and panic spread across the EU, investors began withdrawing assets from the region and turning to safe haven investments like gold. On May 6th at 3:20 p.m., Serrao activated his trading setup, initiating a series of sell orders totaling over $120 million. Within minutes, these orders were repeatedly opened and closed, generating significant trading activity.
For here, guys. All evens are trading. The figure prints are trading. 9 halves are trading here now once again. We got figure trade here now once again. We are trading.
Later, Serrao activated the auto trader, trading a combined value of $3.4 billion in just 2 hours, resulting in a profit of $879,000. Shortly after Serrao shut off his trading program, the E-mini plummeted dramatically, followed by a steep decline in the S&P 500 and individual shares. Panic ensued, leading to a temporary halt in trading as the markets experienced unprecedented volatility. Following the market turmoil and the investigation into the flash crash, Sarao continued to refine his algorithm, eventually achieving all its desired features. He switched to a new broker, RJ O'Brien, after his previous one went bankrupt. Meanwhile, Mr. Jesus provided Sarao with updates on his investments and offered various business opportunities, including investments in emerging gaming companies. Despite his trading success, regulators began investigating Sarao, suspecting his involvement in spoofing large volume sizes at MFM trading. In April 2015, Sarao was arrested in a joint operation by US and UK authorities. His life took a downward turn, compounded by tax pressures, managing business investments, and offshore accounts. In prison, Sarao struggled with his mental health, exacerbated by his autism. Witnessing his cellmate's suicide attempt pushed him to a breaking point. As his lawyers struggled to secure $5 million in bail from his offshore accounts, they uncovered a grim reality. Sarao's business partner, Jesus, was not the savvy money manager he seemed. Instead, Jesus had been running a pyramid scheme, using new investor money to pay off old investors with unsustainable returns. With the scheme based offshore, Sarao's funds were irretrievable. Facing this devastating loss, Sarao found himself stripped of everything. Initially, facing a daunting 22 charges with a staggering maximum sentence of 380 years, Sarao's legal journey took unexpected twists. However, prosecutors took into account mitigating factors such as his autism, time already spent behind bars, and his cooperation with the US government. In a significant development, Sarao reached a settlement with the US government, agreeing to pay $12.8 million, an amount reflecting his earnings from his illegal trading activities. This settlement marked a crucial point in his legal saga. The case sparked heated debates within the financial community, with differing opinions on Sarao's role. While some viewed him as a mere scapegoat, bearing the brunt of broader market issues, others saw him as a symbol of rampant greed and manipulation within the financial system. The hashtag #FreeSarao gained traction among day traders on Twitter, reflecting a sentiment that Sarao had been unfairly singled out. In 2016, Sarao made a pivotal decision by pleading guilty to charges of spoofing and wire fraud. This move helped him avoid the looming threat of a lengthy prison sentence. Instead, he received a sentence that credited him for time already served, ultimately allowing him to return to his home country, the UK. Despite his downfall, Sarao remains a legendary figure among day traders, admired for his journey from humble beginnings to becoming one of the biggest traders in the comfort of his own bedroom. Thanks for watching. Give this video a thumbs up and subscribe for more insightful content. If you enjoyed this video, check out the one currently displayed on your screen. Just click, and I'll see you in the next video.